Welcome to the Explainer. So picture this. You finally get that very first paycheck. You probably remember that initial rush of pure excitement, right? But then, almost instantly, it's followed by this sinking feeling of total confusion. You worked the hours, you knew your rate, you did all the math in your head, but the number actually printed on that piece of paper, it was way, way lower than you expected. You were literally staring down the harsh reality of gross versus net pay.
It's the ultimate, universally relatable question. Where on earth did my money go? It is incredibly frustrating to see your hard-earned gross pay just shrink drastically down into your net pay. But hey, don't worry. By the end of this explainer, we're going to have the mystery of that gross to net pay gap completely solved for you. We'll decode exactly what happens in that hidden space between your employer's bank account and yours, from income taxes to those FICA deductions for things like Social Security and Medicare.
Okay, let's take a quick look at our roadmap for today. We're going to cover 1. The math behind your pay. 2. How progressive brackets actually work. 3. Marginal versus effective tax rates. 4. Calculating federal withholding. And finally, 5. State taxes and your refund.
All right, kicking things off with Section 1, the math behind your pay.
So, before we can even think about calculating a single tax deduction, we need to equip ourselves with some basic mathematical tools. Two of the absolute biggest hits to most pay stubs are federal and state income taxes. And to figure those out, we've got to get totally comfortable with percentages. Now, the word percent literally translates to per hundred. So when you hear about a tax rate of, say, 12%, it literally means 12 out of every $100, or 12 cents on every dollar. Because of this, anytime you want to use a percentage in a paycheck calculation, you have to convert it into a decimal first by dividing by 100.
And there's a really handy practical shortcut here. You don't even need to reach for a calculator for this first step. If you want to convert 6.2% to a decimal, just picture the decimal point right there at 6.2 and simply move it exactly 2 places to the left. Boom, you instantly get 0.062.
So, let's put that to work. If you want to find out what a 6.2% tax looks like on a $2,000 paycheck, you take that $2,000 and multiply it by our brand new decimal, 0.062, and the result is exactly $124. Honestly, that right there is the foundational math you're going to need for absolutely everything that follows.
Moving right along to Section 2, how progressive brackets work.
Now that we've got the math totally dialed in, let's look at the rules of the game. The United States uses what's called a progressive tax system. Essentially, this means that as your income goes up, it gets taxed at higher rates. But how that actually happens, it is widely misunderstood. And that brings us to the concept of a tax bracket, which is simply a range of income taxed at a specific rate. Think of these brackets like a series of buckets. As your income increases, you fill up the first bucket entirely, and then, and only then, the overflow spills into the next bucket. Only the income that actually lands inside that higher overflow bucket gets taxed at the higher rate, not your whole salary.
Which brings us to Section 3, marginal versus effective tax rates. Understanding this next concept is a total game changer. Seriously, a misunderstanding right here trips up even seasoned professionals when they're thinking about, say, getting a raise or a promotion. You'll constantly hear people say, "Oh, I don't want to earn more money, it'll bump me into a higher tax bracket and I'll actually take home less." Let me be clear, that is mathematically false. Your marginal tax rate is just the rate that applies to your last, highest dollar of income, the top bracket you reach. But your effective tax rate, that is the actual percentage of your total income you pay in taxes blended across all of those different buckets. Because only your top dollars get taxed at the top rate, your effective rate is almost always way lower than your marginal rate. So getting bumped into a higher bracket never, ever ruins your whole paycheck.
All right, Section 4, calculating federal withholding. Okay, time to put all this theory to the test in a real-world scenario. We're going to apply these progressive bracket rules to a hypothetical worker. Let's call her Samira. She earns a gross pay of $2,240 a month. Now, for the sake of learning, we're going to use a super simplified 2-bracket model based on approximate 2024 federal figures for a single filer. In our model, Bracket 1 taxes everything from $0 to $11,600 at 10%. Bracket 2 taxes everything over that $11,600 mark at 12%. Real federal brackets actually go all the way up to 37%, but this simplified version is going to cleanly illustrate the math for us.
To figure out Samira's paycheck deduction without getting completely overwhelmed, we'll follow 3 simple chronological steps. First, employers calculate withholding based on a full year, so we have to annualize her monthly income. $2,240 times 12 months is $26,880. Second step, we apply our tax brackets to that annual number. And third, we just convert that final yearly tax bill back down to a single monthly paycheck withholding.
Let's actually watch Samira's income cascade through those brackets. Her first $11,600 completely fills up bracket 1, getting taxed at 10%. That gives us $1,160. The rest of her income, the remaining $15,280, spills perfectly over into bracket 2, getting taxed at that higher 12%. That equals $1,833.60. We add those two amounts together, giving her a grand total annual tax of $2,993.60.
And, this brilliantly illustrates the exact difference we were just talking about. When we divide her annual tax by 12, her monthly federal withholding comes out to $249.47. Her highest dollars were taxed in that 12% bracket, so her marginal rate is 12%. But check this out. If you take her total tax paid and divide it by her total income, her effective tax rate is only 11.137%. See? She definitely didn't pay 12% on everything. And keep in mind, this is just income tax, which is completely separate from that FICA slice you see on your pay stub for Medicare and Social Security.
Real quick, before we jump into state taxes, let's take a mental breather. You might be sitting there wondering, where exactly does all that federal money actually end up going? Well, when we break down recent federal spending, the largest chunks go directly to Medicare and Medicaid at about 24% and Social Security at about 21%. National defense takes up roughly 13%, and, somewhat surprisingly, just paying the interest on our national debt eats up about 10%. The rest, it covers the whole shebang, everything else from education to law enforcement.
And finally, Section 5, State Taxes and Your Refund.
So, we've successfully tackled the federal side of things. Now let's hit that final toll booth on your paycheck, state taxes, and let's discover what actually happens at the end of the year when you file your return. On top of federal taxes, most states collect their own separate income tax, and honestly, the rules are wildly different depending on exactly where you live. Some states use progressive bracket systems, just like the federal government. Others are flat-rate states, taxing all income at one single flat rate. And get this, as of 2024, 9 states, including places like Texas, Florida, and Nevada, have literally zero state income tax at all.
Now, if Samira lived in a state with a straightforward 5% flat rate, calculating her state tax deduction would be an absolute breeze. We just convert that 5% to 0.05, multiply it by her $2,240 monthly gross pay, and we'd see an additional $112 deducted from her paycheck every single month for state taxes.
But wait, here's the ultimate plot twist of this entire explainer. All of these paycheck deductions we just spent time calculating, they are simply your employer's best estimate of what you are going to owe. That's it. It is not your final tax bill. When you finally sit down to file your tax return around April 15th, that is when you are calculating your actual, exact, to-the-penny tax liability for the year.
This completely shifts how we should be thinking about tax season. If too much was withheld from your paychecks all year, you get a refund. If too little was withheld, you owe money. Society has pretty much trained all of us to celebrate these massive tax refunds, right? But read this quote. Getting a large refund sounds great, but it actually means you gave the government an interest-free loan of your own money. The goal isn't to get a giant refund. The actual goal is to have your withholding match your true tax bill as closely as possible, so you get to keep your own money working for you throughout the year. And that wraps up our explainer. We've done the math, we've busted the myth of marginal brackets, and we've finally uncovered where your gross pay really goes. But I want to leave you with one final provocative thought to take with you. Grab your next pay stub and really look at it. Is your withholding dialed in correctly, giving you access to your hard-earned cash right now? Or are you unknowingly lending the government your money for absolutely free?